The Trump administration digging in its heels and insisting that tariffs will hurt China more than the U.S. On Squawk Box this morning, Treasury Secretary Scott Bessent explained why it's in China's interest to reach a deal.
It's up to China to de-escalate because they sell 5 times more to us than we sell to them. And so these 125, 145% tariffs are unsustainable.
Well, consumers here are starting to see the impact. Prices on some popular items sold by the e-commerce giant Shein have reportedly soared by 2, 3, even 4x. The price for a pack of towels, for instance, jumping from $1.28 to more than $6. Eyebrow gel going from less than $1 to $2.90. Joining us with more on the politics of trade now is Tobin Marcus. He's head of policy and politics at Wolfe Research. And for the supply chain and retail impact, Anisha Sherman is senior retail analyst at Bernstein. Welcome to both of you. Tobin, I'll start with you. And I don't think anyone's going to wring their hands over the price of some of these super low-cost items on Shein going up by a couple of dollars. Where do you think the real impact will be starting to be felt?
I agree that the lower price retail items are not going to be the thing that breaks the back of the Trump administration on this. I think the two impacts that I'd be looking at first are the supply chain. There's been a lot of talk, including from Secretary Bessent, about falling container bookings and so forth. As that works its way into trucking, into rail, I think that's one place where we'll start to see real economic pain that might register on the Trump administration's radar. And then the other is inputs into U.S. manufacturing processes, which we import a lot of intermediate inputs from China. Those are just as affected by these price increases as these lower price, less strategic items that consumers are buying. And as you start to see manufacturing SMEs, smaller companies that have a lot less working capital, a lot less ability to stockpile and sort of smooth their way through these disruptions than bigger publicly traded companies do. If they start, cracking, we start to see bankruptcies there. I think that's something that has to be concerning to the administration.
Apollo and others have said if you take the stop in incoming sort of freight and assume that continues, it's going to mean trucking layoffs, and it's going to mean retail layoffs, and it's going to mean a U.S. recession by this summer. The flip side of that, as others are pointing out, is that it looks like volumes are to some extent starting to rebound. So which story is it?
I think if everything stays in place exactly as it is now, and we remain in a world of 145% tariffs on China indefinitely, it's hard for me to see volumes persisting in the face of that level of tariffs. Bessent has said many times over the course of the past week that that's unsustainable, both for the U.S. and for China, and I think that that's true. So I think a lot of the more optimistic stories about where we could go from here rely on some level of de-escalation between the two countries.
Right. So all of that said, is your base case that the economy continues to worsen? And how does that affect the ability, as now we're all going to be turning our attention to the reconciliation bill, the budget bill, whatever you want to call it this week, and seeing if it moves along can maybe blunt some of the economic hit, but then you have to talk deficits and all of that.
Right. I do think that the economy will continue to weaken. I think even if we get some of these deals with countries ex-China that the administration is hoping to get sooner rather than later, for the most part, those will lock in the current state of affairs rather than incrementally easing tariffs, because we'll still have the 10% baseline, we'll still have the 25% sectoral tariffs. Even if we get partial de-escalation with China, we're still going to have quite high tariff rates there. So there's a lot of persistent drag, even in, I think, a relatively optimistic scenario on tariffs. That takes us into this tax debate, which is going to start playing out in earnest in the House over the next few weeks, finally putting pen to paper on this bill for the first time after months of debate about kind of big numbers in the abstract with no actual policy details. That's going to be a thorny debate. I think it'll get ugly at times. My guess would be that bill passes in July. So I do think that we have a ways to go there before we start, getting the chance of, stimulus, reassurance to the business community from that package of tax cuts. And, the net fiscal impulse that we're looking for from that bill is significantly smaller than the drag from tariffs. It's definitely will be stimulative over the next few years, but I think likely not to the extent that the tariffs are contractionary.
Right, depending on exactly what happens there. So I find it noteworthy that the 10-year yield is down to 4.22 today. It's probably the single most reassuring sign for markets, and we see corporate issuances back, and there's other signs that kind of things are getting healthy again. And all of this is happening as the House is probably going to move towards that Senate number. This is going to be a big number for deficits and debt, but if anything, the long end is either saying it's already priced in or shrugging it off, or perhaps looking to the more growthy, long-term aspects of this.
It is going to be a big deficit number. Our base case is for something around $3.8 trillion relative to current law, and I think the risk on that is to the upside. As we see economic weakening, you wouldn't generally expect that to bring the long end of the yield curve down. It was, of course, a kind of an unusual and perverse and worrying outcome that we saw long yields increasing at the same time that we saw stocks falling, the dollar falling. That was not the mix that you want to see. Generally, if we are expecting some cuts, expecting some economic weakness, you'd think that would bring in the long end of the yield curve somewhat. I think that expectations are all over the place for where the deficit numbers on this bill are going to end up. It's a complicated process, a kind of an inscrutable process. Anecdotally, even from fairly sophisticated institutional investors, there's a lot of confusion about exactly how the reconciliation process works and how much this bill needs to be paid for. So there certainly are scenarios where the deficit impact of this bill could surprise substantially to the upside. And I think it is in those surprising scenarios that we start to worry about how bond markets would react.
Yeah, exactly. But things are kind of calm and quiet, at least for now. Tobin, thanks very much. Good to see you today.
Thanks for having me.
Tobin Marcus with Wolfe Research.